Business people are often involved with the financial aspects of an enterprise. Experienced as managers and operators in a business environment, many have not received formal training in accounting and finance, but for different reasons find themselves responsible and accountable in various degrees for some aspects of the company's finance. Most commonly, department managers are responsible for preparing the department's own budget, and with the exception of financial managers, most probably have little or no formal training in budget preparation. Budget preparation, to a large degree, involves an analysis of the current year's actual results and being able to translate planned future operations into financial model. Depending on the individual's level in the organization, this will require to a lesser or greater degree a knowledge of the organization's operation and business strategy. All preparers as well should have a certain level of accounting knowledge in order to understand the financial information with which they're working. This will assist them in understanding past performance and qualifying and making decisions about future planned activities. Financial information can be in the format of financial statements or financial reports. Typically, in a corporate environment, the accounting system is generating monthly or period reports. The type of reports which an individual receives will generally depend on their position and role in the organization. The purpose of the reports will be to assist individuals in achieving their part of the organization's financial objectives and to provide feedback as to how well those objectives have been and are met. Senior management is responsible for the overall financial performance of the enterprise and will require in varying levels of detail each period, and as a minimum, a complete set of financial statements comprising the earnings statement, balance sheet, statement of retained earnings, and cash flow statement. Department managers and heads within an organization will be provided with reports setting out the different expenses that the department has incurred and for which they are being held accountable. Where these individuals are responsible as well for certain revenues, these items will also be reported. In summary, individuals will be provided with whatever financial information, usually in report format, they require to assist them in reaching the organizational goals for which they are held accountable. Budget amounts should be reported alongside actual results on a line-by-line basis. In this manner, actual results can be compared to planned results and any necessary corrective action taken. Some knowledge of accounting will help managers better interpret this financial information. Budgets are financial models of planned future transactions, prepared to provide a method for evaluating and controlling future operations and activities. Budgeting is the process of preparing budgets. Budgeting requires a detailed knowledge of the business, the type of activities that are taking place, future planned activities, and how these activities will affect the operating costs and revenues of the business. Required as well as a certain level of understanding of financial statements and reports, and the mechanics and concepts behind the reported data. Given this knowledge, however, useful information can only be obtained and acted upon if there is also a familiarity with basic financial analysis tool. Although the budget commonly covers a fiscal year, longer time frames may be involved depending on the organization and its circumstances. For instance, a company may have an annual operating plan as well as a strategic plan to expand the business, which could cover much longer period. Every business requires a plan or roadmap which sets out business goals and objectives and the steps it will need to take to achieve those stated targets. The corporation's business plan will set out in detail these aspects, and the budget will express in financial terms the plan for the budget year. The importance of having in place a budget cannot be underestimated. Listed below are just a few of the reasons an organization would prepare a budget. Control and protection of cash flow. Costs can quickly become out of sync with revenues unless management has established a budget. Since costs, for the most part, represent negative cash flow, uncontrolled costs can lead to solvency problems. Solvency is the ability to pay debts and liabilities as they become due. Therefore, a properly administered budget will help protect a company's cash flow and add to its chances of survival in the short and longer term. Enhances control of operations. It is true that numbers tell a story. With proper monitoring, unfavorable variances can be pinpointed quickly and corrective action taken to bring operating results of the department, division, or company back into line with the budget. Promotes greater understanding of the business. A certain level of knowledge about business is required to correctly interpret its financial statements. However, to prepare an effective budget requires a much greater understanding of the business operations, the industry within which it operates, and the impact of the economic conditions at the time. Essentially, it is business operations that are generating costs and revenues. Therefore, to prepare an effective budget will out of necessity require and promote a greater understanding of the business and its operations. Performance evaluation tool. Assuming managers are committed and have taken ownership of their budget, such as a document can serve as a way to motivate personnel to achieve stated corporate goals. Organizations often have in place programs that reward managers for meeting or exceeding budgeted results. Serves as a planning tool for the entire company. The budget process forces all departments and the parts of the company to formally evaluate past performance, prioritize programs, and establish objectives for the future. Facilitate coordination of activities. The sales budget will ultimately drive other budgets. The most direct link between sales and purchases in a retail and wholesale environment and sales, production and purchases in the manufacturing business. In a professional service business, the number of hires is directly related to the level and type of fee income. Depending on the size of the organization, the preparation of an effective budget requires the coordination and input of many individuals. In many cases, the process starts at the senior executive level. Several months prior to the end of the fiscal year, these personnel will review company-wide results, set objectives for the coming budget year, and make recommendations to the president. The budget eventually reflects these preliminary objectives in a greater or lesser form. Depending on the corporate environment, the president may play a much more active role in establishing these corporate goals. There are two philosophical budgeting extremes and approaches. In one approach, senior management imposes its performance targets on the enterprise as a whole. In some cases, these targets could be unrealistic, and since there is little consensus building with middle management, there is minimal buy-in to meet what may be viewed as unrealistic targets. Employee morale suffers from the outset because of the perception that performance goals cannot be achieved. This is particularly so if employee compensation is partially tied to meeting and achieving these mandate targets. A further problem exists where performance targets cannot be achieved. The cash and capital budgets are intimately related and linked to the operating or revenue and expense budget. A shortfall in operating performance when compared to budget, could lead to financing and capital budgeting problems due to the shortfall in budgeted cash flows. The opposite approach, where senior level management essentially accepts middle management's budget, could present its own potential problems. Although the preparers are committed to their budgets, the targets may be too easy to achieve, thereby compromising some enterprises' full potential. This situation also negatively impacts budgeted expenses, where compensation is partially related to meeting or exceeding performance benchmarks. The optimal process, likely followed by many organizations, involves both approaches. Middle management prepares and submits to senior management what it considers a reasonable and achievable budget. However, senior management will critically review each individual plan to ensure that the enterprise's full potential is reflected in the overall budget. Under this scenario, middle management will need to support and defend their budgets, and it is almost a given that some individual plans will require amendments.